Whenever I see luxury cars driving down the street, I used to wonder, how can so many people afford these? You'd assume they must be incredibly affluent. Well, not quite. A significant number of those drivers aren't wealthy. They are just deeply in debt. A prospective buyer recently sought to trade in a Ford Lightning for a Mercedes GLE coupe, but that potential customer owed about $87,000 on the pickup truck. Horner estimates the Ford pickup truck was worth about $47,000, leaving the buyer well underwater. This person was in $40,000 debt before even signing the papers for the new Mercedes. It makes me realize how desperately we need personal finance education in our schools. But at the same time, looking at our current public school system, I have to wonder, would it even stick?
Average monthly finance payments are on pace to be $760, up $24 from January 2025. The average interest rate for new vehicle loans is expected to be 6.29%, down 0.48 percentage points from a year ago. Even though lower interest rates should theoretically reduce the financial burden of a car loan, average monthly payments are still rising. This suggests that buyers are either choosing much more expensive vehicles or financing larger amounts of existing debt. As the total debt burden grows and monthly payments become increasingly unaffordable, many buyers are turning to extended loan terms, with some even opting for 100-month loans. Since the total loan amount remains the same, borrowers are forced to choose between higher monthly payments or a significantly longer repayment period. Increasingly, people are choosing the latter, paying less each month but extending the debt for years, essentially pushing the financial consequences into the future. In a way, this reminds me of how we manage debt as a nation. One of the main reasons people are getting buried under car payments is that affordable, cheap cars are becoming nearly impossible to find. The average price of a new car broke the $50,000 barrier this fall, according to Kelley Blue Book. It comes down to a shift in strategy for automakers. They are prioritizing high-end models and luxury trims because the profit margins are so much higher. If a manufacturer has a limited supply of chips or resources, it makes more sense for them to put those parts into a vehicle that brings in a massive profit rather than a budget-friendly sedan. We're seeing this same phenomenon in the housing market, where starter homes have essentially disappeared. As cars become increasingly unaffordable, President Trump has recently floated the idea of bringing K cars to the U.S. market.
Very small, they're really cute, and I said, how would that do in this country? And everyone seems to think good.
These are tiny Japanese vehicles that are roughly 30% shorter than a Toyota Camry. In Japan, they are incredibly popular, often costing as little as $10,000. Trump's embrace of K cars comes as the administration is trying to address affordability. However, they don't meet U.S. safety standards. These cars lack the structural compliance, side impact protection, and front-end crumple zones required to be legal on American roads. Imagine driving one of these on a highway at 80 miles per hour, right next to a 6,000-pound Ford pickup truck. Beyond safety, there's the question of whether Americans even want small cars anymore. Over the last decade, the average car in the U.S. has grown by 12% in length and 17% in width. In fact, last year, only 88,500 subcompacts were sold, accounting for less than 1% of all total vehicle sales. Americans want big cars, but their choices are increasingly limited to expensive models. This is where predatory lending steps in, making it easy to fund these high-priced vehicles. Tricolor is one of the companies operating in this predatory lending space. They target vulnerable borrowers, including those without a Social Security number, by offering subprime loans with high interest rates and large down payments. For many of these people, there is simply no other choice. When borrowers inevitably fail to keep up with the payments and default, the lenders are ready. Most of these vehicles are equipped with GPS trackers, allowing the company to easily locate and repossess the car. They then resell the same vehicle to another borrower in the same situation, and the predatory loop continues. These companies aren't even risking their own money. They bundle these loans and sell them to big Wall Street investors as asset-backed securities. And it's not just these smaller, shady companies getting in on the action. Industry giants like GM and Ford have got permission to set up their own banking units. Their goal is simple: offer more loans so they can keep increasing their sales. Although these companies claim they are providing more loan options to keep cars affordable.
With the way the system is currently set up, we are seeing subprime auto loan delinquencies hit record highs, while prime loans remain relatively stable. Curiously, this rise in defaults isn't spooking Wall Street. To big investors, these loans are still highly profitable and, based on their risk assessments, are still considered managed risk. Once again, we are witnessing a K-shaped economy in the car market. The wealthy are doing fine, while low-income drivers are being crushed by debt. The people forced into these subprime loans are usually in the lower income brackets. They are the most susceptible to default, which creates a desperate cycle. Their debt snowballs, and they end up trapped in these loans for a decade or more. If you're looking at a car right now, the math is stacked against you. In 2026, the most valuable car you can own isn't a brand new SUV. It's the one that's already paid off.